Yesterday, the Fed gave us the 0.25% rate cut we were expecting, but the market was not expecting Powell to be as hawkish going into next year. In fact, he said we were only going to see 2 rate cuts. The market had priced in 3 or 4. And this led the US dollar to have an extremely strong session. We're looking at a weekly chart of the US dollar, and we're above the resistance zone from last year. This looks like it could be a potential breakout, and as we've talked about multiple times, a strong dollar tends to be a headwind for stocks. We also saw the bond market take a beating as the bond market realized we were not going to get as many rate cuts as expected. And when we pull up a chart of the 30-year bond, next, you can see we're back down to the lows from earlier this year. We're not quite at last year's lows, but the bond market looks to be in trouble here. Pay attention to the April lows. If that goes, watch last year's lows down at that 106 zone. There was a ton of movement and a lot of things to pay attention to after yesterday's move. Thankfully, today the markets are up about 0.5 to 1% depending on the index, so we're not seeing a major multi-day slide, but there was certainly a lot of damage done yesterday as the market really didn't like what Powell had to say about the future.